What's going on, everybody? Good morning, and welcome back to Beat the Bell, presented by King Capital. Hope you guys all had an amazing weekend. I want to first have an open discussion here with the panel before we get into today's show about August and its price action thus far. We kind of knew and anticipated that coming into August, things would be a little bit more tactical. What's everybody's thoughts? There's chop, and then there's August. We'll start with Money Mander. Money Mander, good morning.
Top, and then there's what we've been seeing. I feel like right now you're getting smoked if you're playing for the outside move. It's really a level-to-level thing. Play long to your next level of resistance, short to those levels of support. But if you're looking for those breakouts and those really outside days, we just haven't been seeing them. So it's definitely a tactical market right now. I think you got to take that into consideration.
I would 100% agree with that. There has been so much opportunity. The only people that have really been getting in trouble are the people who are still trading like it's July. And what I mean by that is the people who are shooting for those home runs. Diamond, what are your thoughts?
I mean, I like you said, like the price action has been a bit choppy, but there hasn't been a lack of range, right? Like intraday, we're getting crazy point swings. I mean, what was it? Thursday, we sold off like 200, 300 points high to low in NQ. So there's definitely range there if you're an intraday trader, and especially if you're like a reversal trader, like I know a lot of people are, then there's going to be a lot of intraday reversal as opposed to, like you said, July price action where we're kind of just one directional for the entire day or maybe even like the entire week. You're getting a lot of different looks, and so I do think that there's a lot of opportunity in this market. You just got to be pretty nimble, pretty quick, and like you said, don't fall in love with a thesis or an idea because the market tide is just shifting a lot quicker this month for sure.
All right, and Snipes.
Yeah, I mean, it's August. As far as scalping, the opportunities are still there. If you wait patiently and you look throughout the day, you'll find one or two. Can't take everything that comes out there, though. I mean, if you just jump into a trade pretty quick, the market will humble you within a couple minutes. And I'm sure that those who scalp definitely have encountered that maybe once or twice in August. I'm not really sure, but yeah, you just got to be a lot more selective in August when it comes towards scalp.
Absolutely. Important word to use there is selectivity. I think that that's crucial, especially in a market environment like this, because as we've been mentioning here, there has been a lot of opportunity and there have been some pretty violent price swings intraday. And if you're trying to chase every single one of those, you're probably going to end up on the wrong side of things. So important to make your money and get to the sidelines and then repeat. All right, let's dive into Fed forecast and economic calendar.
For sure. Let's start with the economic calendar for this week. It's relatively light. The biggest news is going to be Tuesday with retail sales before the open at 8:30. And then Wednesday, we've got building permits before the open, as well as FOMC minutes release from the July meeting. Those minutes will come out on Wednesday at 2 p.m. Thursday, we've got the weekly unemployment and Philly manufacturing. And Friday, no high impact news. So pretty light, stacked towards the front of the week here. And then we've also got some more earnings this week. So we've got, Ryan, if you want to talk the earnings calendar, some of the main names that we're watching for this week are going to be Home Depot, Target, Walmart. A lot of those retail companies, TJX, are going to be reporting earnings this week. And so definitely something to watch out for. Their middle of the week is going to be pretty packed as far as news and earnings goes. Speaking of earnings, this season hasn't been an easy one. This earnings season really hasn't been an easy one as companies struggle to fit into the valuations they achieved after the rally over the last several months. Companies are reporting fairly well. So of the S&P 500 companies that have reported, 79% of the S&P 500 companies that have reported are beating median analyst expectations for EPS, for earnings per share, which is above the 5-year average of 77%. However, the market is not rewarding positive earnings to the same degree that it's punishing negative ones. So according to the journal, companies that have beat expectations have seen shares rise 0.5% on average in the trading session following the report, compared with the 10-year average of 1.6%. From the investor standpoint, you have stocks that have performed really much better than anticipated this year, particularly large cap tech, many of which are reporting their third consecutive quarter of decreasing profits. If you follow Markets and Mayhem on Twitter, and the Trader Aid crew, you'll know that they've been talking about this earnings recession that has hit the S&P 500, with earnings sort of shrinking over the past several quarters. So given sort of where we are from a fundamental standpoint, where we are from a price action standpoint, some of these large cap tech names are trading at all time highs. Some of them are within spitting distance. You have to start looking at the environment, right, where you have companies that may not necessarily be reporting great earnings, and even a lot of them are lowering their guidance going forward relative to the expectations coming in. You have a situation where the S&P is down 2.7% in the month of August, bringing the year-to-date total down to about 16%. So it makes sense to want to sort of take profit here and look for other opportunities, particularly when you have a risk-free rate that's above 4%, right? And so the headwinds of the market so far this month makes sense. It's not just, I think, in my opinion, the seasonality that we've been seeing. It's just it's an actual grappling with, okay, markets have rallied this far. Here comes earnings. How are these companies going to be able to fit into the valuations that they've achieved? Rallying 2, 3, 4, 5x off the lows. You know what that's going to do to your to a lot of your fundamental metrics, and I think that's something that people are definitely paying attention to. Looking at the alternatives out there, 4% risk-free rate, and kind of making some decisions, taking profits into this earnings season. The one thing to look forward to this week as earnings season continues, the performance of consumer staple shares have done the best relatively so far this earnings season, which we have several of them reported in Walmart, Home Depot, TJX as we reported. So stay tuned for those and any other broader sector or market impacts that they may have. As you guys can see, those consumer staple names are performing better after their earnings than any of the other sectors. And we have a lot of those names reported this week. So something to pay attention to. Mander, what do you got?
I give my 2 cents. Can we go back to that earnings calendar? Can you pull that up for us?
Yeah.
Right? Nope.
There you go.
The economic calendar. Back one more for me.
Oh.
Yeah, no, we definitely do not claim or approve of this spelling of Philly. I just had to put that out there. Who did that?
I think that was a copy and paste off of Trading Economics.
That's like chili with a P.
All right, look, it's Fila. Maybe if I put a little A at the end of there, Fila. I mean, when you say Philly out loud, that's how you would pronounce it, right? You would pronounce it Philly. Yeah, I mean that is. Am I incorrect in saying that? Philly, right?
All right, my 2 cents though to segue off of you. I think really exactly what we talked about going into earnings, and especially mega tech, which I'll hit on first. We were saying that AI and the hype around AI really drove those multiples up before the earnings. And it was kind of like the running joke for the past earnings that say AI as many times as you can and just run your stock price up, right? And so eventually we were going to get to that point where, as you mentioned, we just have the 10-year trading into new decade highs in terms of real yield with inflation adjusted. So it's back above 4%. It was above 4% before, but you had 5-6% year over year CPI. Now with that down below 4, I think is trading at like a 1.5 real yield right now, which is the highest we've seen since 2009. So all of those kind of factored in. It looks more attractive now than ever, I think, to take profits for some of those people that were long out of the hole, as we're starting to see 3 quarters straight of slowing profitability. Obviously, these elevated rates are hurting these companies over the long run here for profitability. And now you have a legitimate, real positive yield on some treasuries. I think that's probably what we're seeing. And on top of what I'm going to segue into, some more updates out of China, which is really looking worse and worse by the day here. We have another property crisis going on here in China, which I know was the big headline here in the States. We thought we were going to have this commercial real estate issue. It's actually hitting China here first and starting to spill over into the broader economy here. The new one on name here is Country Gardens Holding. If everyone remembers Evergrande, which seems like forever ago, really wasn't, going back to 2021 and 22 when Evergrande defaulted on their debt. We now have the second largest property holder here in China, also suspending payment on their interest and suspending the trading over the weekend in 11 of its yuan-dominated domestic bonds here. So basically, they didn't have the money to pay out the interest payments, not quite extending a full default yet, but suspending trading and suspending payments on the interest of those right now, falling 18% at the open of the session here on Monday's Asia market open. That's like futures trading for us. If you go ahead and look at the NASDAQ, it sold about 100 points at the start of the open, rebounded back green, But this really just starts to see everything we're starting to get out of China right now is really dragging. We talked about the deflationary situation last week. Now another property issue moving forward here. It says data showed Chinese banks extended the equivalent of $47.8 billion in new loans in July, which is down nearly half from the same month a year ago. So July 22, new loans getting cut in half, and also a decade low here. So really it just seems everything we're getting out of China here is slowing demand, slowing consumer. And obviously that is hitting the Asian markets first here, with a lot of these Hang Seng and other indices down about 5.5% year to date. Hasn't really hit us quite yet in the States. But if you look at names in the Dow Industrial like Caterpillar and consumer discretionaries like Starbucks, like Apple, a lot of these names have massive percentages of their revenues coming out of the China economy here. And so if we're really starting to see a full slowdown here in the China consumer with deflationary situations hitting down year over year, now new loans coming out of banks at decade lows, not looking too great really coming out of China. I think the big question is going to be, does China implement any stimulus to pull themselves out of the hole, or does this then start to roll over into the global economy that really relies on China for a lot of revenues?
I think not just from the consumer standpoint too, right? You're going to have from the B2B standpoint as well. I'm looking here. You've got Caterpillar saying that Chinese orders were down 20% in the first quarter, 40% in the second quarter, and 50% in June. I mean, when you're looking at some of the more infrastructure plays, right? Who is helping to build that second largest economy in the world? There's so much new development going on over there that you had a lot of B2B companies really benefiting as well from that Chinese exposure, not just the retail facing companies. And so those companies as well are going to have to struggle and find that a new source of sort of income to at least help buffer that lack of like industrial spending in China. So that's going to be interesting as well. And then, like I talked about earlier, I mean, looking at the earnings calendar, I'm trying to see any of these names with particular Chinese exposure, which I don't really see. Obviously, JD.com is going to be an important one out of China. But outside of that, I think that's probably something else that you're going to want to focus on this week heading into earnings, is any companies with major Chinese exposure. And see if that is sort of reflected in the price action over the past several weeks, as we've gotten this recurringly weak data out of China. So that'll wrap it up for us here at Fed Forecast, and pass it back to Alejandro.
All right, thank you, fellas. Let's take a look at the system quickly here. So, as you guys can see, choppy. We've been talking about it. This sort of range-bound price action that we've gotten during August, and it's been a slow grind lower, but there has been so much opportunity to trade this. It's honestly been a really good month for day traders. But as we talked about, those looking for those giant trend moves are the traders that have been getting in trouble. We had a lot of that in July when we got the breakout on July 12th. We rallied about 150 points, signaled by, of course, the system buy signal, and the 50 SMA served as support for the entirety of the run up. But now things have gotten much more complicated. So as far as using the system for trade entries and exits or actionable trade ideas, I have been completely hands off. And the reason for that is that when we get in a range, what's most important is your support and resistance levels. Now, looking at the system is still extremely useful because we know that it can help us identify the short-term trend. And so SPX finally filled this gap here. All right, so we've been sitting at this major support area that we've been talking about. This is the back test of the breakout. So we did come down, we filled this gap. We're still sitting at major support. So when we're sitting at major support and we know we have these major resistance levels coming down, which is the 50 SMA, we know we're going to be in a range. What's most important, again, is charting out your levels. Mander mentioned it earlier, taking trades one level at a time, getting in and out, and getting to the sidelines. So until we can break back over the 50 SMA, or until we lose this major support, which we're sitting at here in the pre-market today, it's likely that we won't be getting another trend leg. So it's important to watch for that. So if we do get the buy signal to break over the 50 SMA, then maybe, just maybe, we could get a trend leg into the second half of August. Or if we do break down, and at this point, given that we're trading below both the 50s, there's a slight bias that is more likely to happen because of that downward pressure. And as you guys can see, shorting the pops has, of course, been a winning trade below these 50 SMAs. So not much to do regarding the system until we do get a bit more trend, until we break out of this range. So right now, nothing more important than just charting your support and resistance levels and trading those. But that is generally always the case. All right, so that's going to do it for the system. I'm going to go over to Stock Snipa now for Bet the Bell.
Good morning, guys. So today we got Bet the Bell. We got some pretty interesting question for you guys. Let's start it off by taking a look at the stats. We can now see that Diamond and Hondo are tied for the wins at the top. Pretty close right there. They're going neck to neck for the last couple of weeks. Pretty interesting to see how this is going to pan out. But I'm going to go ahead and dive right into the first question today. Green or red? What do we got? I'm going to start it off with Hondo.
I am going to go. Come back to me. I'm not going first.
Whoa.
Am I allowed to do that?
You see that right there? You see that right there, America? These are the types of things that go on, right? And then people want to complain later on. Like these are the types of things that happen. I'll gladly take it on the show. I'll go first. I'm gonna go red. Go ahead, Hondo.
I was gonna go green. Anyways.
All right, good.
I'll tail up the caboose here. I'm gonna take red with Diamond today.
No, I know I'm definitely right.
I'm gonna take green.
No,
I think Hondo's right.
Maybe wrong.
We'll see how this pans out, but weird move. I'm not gonna lie, a little interesting right there, but
yeah, a little weird. But
no, honestly, I hadn't looked at where we were in the pre-market in like 30 minutes. So yeah, I just had to check quick before I made my decision.
Okay.
Sorry.
No, you're good. So I'm gonna dive into an interesting question. I know that Mander and Diamond are gonna love this one, but U.S. money market funds have now surpassed $5.5 trillion, making a new all-time high. Now, my question for you guys is, what do you think has caused this new all-time high in U.S. money market funds? Could it be interest increasing? Could it be money? Why could this money be moving into the money market funds? I'm really interested to hear what you guys got to say. I want to start this one off with Money Mander.
No, send it to Diamond first.
Are you guys kidding me? Like come on.
So, for money market funds, I think when you look at where the interest rate is right now, it makes sense. This is the first time that we've had interest rates as elevated in my lifetime. Over the past couple of decades, and so I think a lot of people are trying to take advantage of this opportunity, particularly not knowing what the future is going to hold for the stock market. Are we going to go into a recession like Moody's thinks in the first half of 2024? Is there going to be a soft landing? Is AI going to take over the world and the S&P 500 goes to 10,000? Nobody knows. But one thing that you do know is the United States pays its debts, and right now they're offering 4% on short-term loans. So, I feel like that's got to be the reason.
Yeah, as we said on here, probably, I don't know, a week ago, we were talking about the equity risk premium. And so right now the equity risk premium is at decade highs, if not 2-decade highs. So really the cost you're paying to be in the stock market versus what companies are earning is higher now than it's been in 20 years, while you have short-term treasuries at over 4%, really the highest we've ever seen since before 2008. So I think that's probably why. Obviously, there's a strong consumer still, so it's not like there's a lack of money in circulation, and the consumer's still been strong with unemployment low. So there's still money out there, but people just don't really know where to put it. And I think right now, with treasuries elevated, it makes sense for a lot of that to be going into these short-term money market funds. If you missed longing the whole, I think this is what a lot of people are doing.
Can agree with that. So obviously the 4% yield in those T-bills is nice. I think that coupled with the fact that investors got a little soft last year due to the volatility. A buddy of ours, who is not to be named, parked a lot of money in T-bills right at the bottom. So to me, this is really just a lot of people who, when volatility comes and when the macro gets gross, people like to take the safe play. So for me, this is a pretty good sign that we're going higher. That equities are going to go higher.
Yeah, I like that. And it makes sense for money to be stored inside of a money market account as opposed towards checking and savings, obviously, because of the higher amount of interest. So
it's funny you say that because these savings accounts nowadays what's Apple is like 4.6% maybe. I've got a Capital One that's 4.3%.
Savings?
The
You sure it's not money market?
No. Regular savings account 4.3% with Capital One. Pretty incredible stuff.
Yeah. That's really incredible, actually.
Yeah.
Yeah, so like I know a couple
I'll
of
refer you.
I'm sorry?
I said I'll refer you. And then
Yeah,
maybe we can both get something out of that.
yeah, we could actually do something there.
Yeah.
But I mean, I have I want to say like 5 or 6 banks, and I mean, they've been pushing the money market pretty hard. They've been pushing the CDs pretty hard, but they have increased the money market interests multiple times this year. I mean, not all of them, but a couple of them. So I feel like that does have a little factor there. Yeah, just a disclosure, this episode is not sponsored by Capital One, and we are not affiliated with them. We're just talking. But I'm going to jump over towards our next question, and this is a New York City question, specifically geared towards Hondo and Diamond. I think that they're going to like this one. But now we can see that rent is actually surging in NYC. We can see this tweet by Unusual Whales that will tell us that the average, and keep in mind, this is average. This is not like the high. This is not the low. This is the average. The average Manhattan rent just hit a new record of $5,588 a month. Now, the general rule of thumb is you shouldn't be spending more than a third of your income on rent. That's been in the book since day one. But for that to be affordable, that means that somebody needs to be making more than $16,500 a month in order to be technically, by the books, affordable to live in Manhattan. Now, my question for you guys is, what do you believe is causing this rent to surge in NYC? Do you think that it will continue to do this? And do you think that action will need to be taken to kind of make it more affordable in the future? What do you guys think? How do you think this pans out? I'm going to go ahead and start this one off with Hondo.
I think post-pandemic, the demand to live in NYC as things, quote unquote, return to normal has been super high. And that coupled with inflation has just created this outrageously expensive environment. And rent is, one of the main numbers that people look at. But even just everyday stuff like going to the corner store, going to the grocery store, or Ubering in the city, New York City has to be the most expensive place, if not, maybe LA or Miami are right up there with it, but the most expensive place to live in all of the United States. And I think that it's going to continue, honestly. I think it's going to continue because, as I mentioned, as things are returning to normal and the city is coming back to life, people are just flooding in and everybody wants to live in New York. So yeah, I don't see things slowing down, quite honestly.
Okay, I like that. I'm going to go to Money Mander next with Diamond Trades as the anchor.
Fantastic. Pull this tweet up for me again, Ryan, if you can. I think this in particular may be a little skewed by statistics as it's the average, right? And the mean in Manhattan is clearly going to be jacked up with a lot more $20,000 apartments than you're going to have at $2,000 apartments. So I think you have to take that into consideration. This is probably the mean in this situation is well above the median. But even with that being said, it clearly is the most, I think this has to be the most expensive real estate in the country right now to rent is in Manhattan. So make no doubt about it. It definitely is extremely expensive. I don't really know what the comparison would be between wages and rent to kind of justify that. Obviously, you're getting paid more in New York as well. But I think that's why you see pretty much everyone living with roommates until you're like 25, 26, 27. And then you get out of Manhattan and go get a place somewhere else. It's just so expensive to live in a 1-bed, 1-bath by yourself in the middle of Manhattan. You really just have to be making a ton of money, as you said.
So I got
an interesting number.
The mean
you mentioned the median, which obviously I wish we had that, but an interesting number would be mean per square foot, average rent per square foot, because that's when we would really see
that's the real comparison.
Holy shit! Because if you're paying $5,000 a month, the amount of space that you're getting is not a lot of space.
So I got the mean number for you guys. The mean is 4550, which is significant.
Median, you mean?
Yeah, median. My bad.
Yeah. Okay.
But yeah, our median is to do the math. That's about $1,000 and 1030 less. But that still is pretty high in my opinion.
I mean, you know better than I. What does $5,500 get you there? Like 800 square feet? 1,000?
I don't know off the top of my head.
I think the guys are right to point out the per square foot, because I do think that would give you a nice comparison relative to some other places in the country, in the world. But I've said this on here, before, and I'll say it again. And New York is unique in the sense that, when you're in the market for housing in New York, you're not just competing with the people in New York, you're competing with the people all over the world. And so prices are always going to be ridiculously high. It's not just, this small pool of people that sort of that you're competing against. You're competing against, people from Europe, people from Asia, people from Africa, people from South America. Everybody wants to live in New York, right? Regardless of, what Twitter will tell you, right? There's a lot more people who want to live in New York than who don't. And that's exactly, that's reflected in the rents. There's a high demand for living in a place like this. And especially for renting right now, as people, the price of actually purchasing real estate in New York has just gotten so absurd that it almost seems, it seems so difficult and unattainable to really like own a place. And renting right now, it sort of makes sense. And so it's not super surprising to see the rents elevated. And I agree with Alejandro. I don't really see like a turnaround there unless the demand to live in New York somehow goes away, and I just don't really like see that happening anytime soon. So I agree with the guys.
I think I like that answer, man. I agree. I don't think that demand's going anywhere anytime soon. I don't really know what anybody could do, about it. Like, it's not like the government can intervene and say like, yo, you have to lower your rent. They can't do that. But yeah, I think it will continue to surge. And I think that we could be looking at twice as much, in a decade from now. But I'm going to jump over to our final question for the day. And this is one of those would you rather questions. And I want everybody to keep in mind, anytime I ask one of these questions, the rule is that you get the stock at current price, at market right now, and you must hold it for a full year. You cannot sell until a year passes by. But now I'm going to go ahead and say, would you rather own $1 million worth of Snap, or would you rather own $300,000 worth of Meta? I see everybody's looking around trying to figure out what Snap is sitting at right now. I'm going to go ahead and start this one off with Money Mander.
I don't even need to know where Snap's sitting at right now because I think the thing is so beaten to crap. I'll take $1 million of Snap right now over $300,000 of Meta.
Really?
I will.
Okay. I mean, like, yeah, it's significant. It's like we're looking at 250% more. So can't hate that. Snap's sitting at $10 right now, but Snap has been deleting people's accounts left and right. That's less ad revenue for them, which is their primary source of revenue there. But Meta has a bunch of other projects going on, and we don't know if they're going to go belly up on some of those or if they're going to boom on some of those. But good answer. I like it. I'm going to go ahead and ask Hondo now. What you got? 300,000 worth of Meta or 1 million worth of Snap?
I'm going with Snap for sure. Give me a 70% head start here. I think that, I don't know, why not? Why would you not? Especially because Meta's been absolutely ripping. Like, Meta could very easily spend the next 8 months doing absolutely nothing,
Okay.
Famous last words.
Famous last words until it's at 500.
Diamond, what you got? 300,000 worth of Meta or 1 million worth of Snap?
I don't like this question because I think that it's tilted. I think that when you get like the initial allocation is kind of messed up. 1 million versus 300. Like, I'm obviously going to take the 1 million in Snap. They can go down 50% and Meta trades flat, and I still have more money at the end of the day. So I'm going to go with Snap. I don't like the company at all. I hate the stock too. Like, I hate them both. From like a business standpoint and from a stock standpoint, from both. I don't like it. But I'm gonna go with Snap just because the initial allocation. I mean, 1 million versus 300,000. Like, what would you need Meta to do relative to Snap to break even, right? Like, you would need like a double out of Meta, which has quintupled off the lows, and you're gonna need Snap to get cut in half. So I'm gonna go with Snap.
All right. Yeah, that'll wrap it up for Bet the Bell today. But we just got it on the record that all three of you guys just said you'd take 300,000 worth of Snap versus $1 million worth of Meta. So
Yeah, we'll have to check that in a year. Check that in a year. Snap's going to be it.
million is
Not
Snap.
what we
Don't
said.
twist it. Don't twist it.
Did the opposite.
$1 million of Snap.
Yeah, $1 million worth of Snap. My bad. I said that wrong. But still, Snap gets unlisted. I'm going to be like, I told you so, guys. I'm going with
Snap's
Meta.
going to $2. Yeah.
Listed. All right. That's going to do it, guys, for Beat the Bell this morning. Appreciate everybody tuning in. We'll be trading live in the Kane Capital Discord. And go to kane-capital.com to trade with us. Scan the QR on the screen. We got a 7-day free trial going, as always. We will catch you guys back here on Wednesday morning at 8:30 a.m. Eastern Time. Have a great rest of your day, everybody.